and acquisition. As we said before, merger is forming of a completely new company, while acquisition is acquiring company, buying or acquiring the target company. So the acquiring company stays as a parent company, and the target company becomes the subsidiary. So no new company. And mergers and acquisitions both have the same purposes, but also they differentiate a little bit by, like, in case of mergers, the main purpose would be the decreasing competition and increasing operational efficiency, while in acquisition, companies aiming for an instantaneous growth could acquire another one. And in case of mergers often involve the same size companies, while the acquisition involves the companies, one bigger and the other one is smaller. So this would be their main differences. So now let's move on to the real-life examples of mergers and acquisitions. And the first example is the Kraft Heinz company, which is the example of a merger. And this merger occurred in 2015 and was between the Kraft Foods company and Heinz company. These two companies both operated in the same industry of the packaged, and they combined their strengths to to solidify their market position.
Oh, sorry, Undral. I think there was a disruption. Somebody's
Okay.
Okay. I think it's been solved. Okay.
Okay. This example is used as a textbook merger because both companies at the time of a merger was similar size, and the new entity was formed, and which is the Kraft Heinz company. Before it was Kraft Foods and Heinz company, and combined they became Kraft Heinz company. And the goal of this merger was to reduce competition, achieve economies of scale, and increase operational efficiency. So we can say it was a horizontal merger because they operated in the same industry and same product. The next example is acquisition of Instagram by Facebook in 2012 for $1 billion, of which around 300,000 was paid in cash, and the remaining amount was paid in stocks. And so at the time of this acquisition, Instagram had no revenue, but a fast-growing user base, around 30 million users around 30 million users. And the company behind the Instagram was the Bourbon, which does not exist now, and because it was acquired by Facebook. And Facebook saw the chance to expand its reach eliminate a rising competitor and accelerate growth. So they acquired the Instagram. And this deal created strong synergies. Like Instagram scaled very quickly, and we know it now, right? Everyone uses it, and it became a major source of ad revenue. And this example shows how strategic acquisitions and mergers can turn a small startup into a global powerhouse. Do you have any questions till now?
Hello everyone, any question you might have to, you can simply ask a question to Undral, or perhaps if you don't feel comfortable too, you can simply type your question on Zoom chat. Again, I can read it out. Any question, everyone? Hello?
Okay.
It seems there's no question. Yeah, okay.
This previously discussed mergers and acquisitions were all like friendly, meaning that both sides, right, the acquiring and the target company, all accepted the deal and made this agreement. But on the other hand, there are hostile takeovers. When a company attempts to gain control of another company without the approval of the target's management or board of directors. And so when it means that the target company is against the deal, against being sold to the acquirer, but the acquirer company wants to go through this deal because maybe the target company is strategically very beneficial for the acquirer, or it could have like very advanced technology. It could be anything. It means that the acquirer company wants the target company, but the target company does not want this deal. We call it a hostile takeover. So these situations can be very intense, strategic, and have very high stakes. So to defend themselves, target companies use several tactics. There are like very many tactics, but I have included the most common ones. So starting with the poison pill. This makes the company less attractive by allowing existing shareholders to buy more shares at a discount, diluting the acquirer's stake. Meaning that if the acquiring company gets a hold of the maybe like 15 or 20% of the target company shares, then the target company shareholders can buy its shares in a very low price, discounted price. So this makes harder for acquiring company to obtain enough shares to get a hold of this management. The next one is the greenmail. We know that blackmail, right? And it's a greenmail. Greenmail means that the target company pays a premium to the hostile bidder to buy back its own shares and stop the takeover. So it means when we blackmail, in case of a blackmail, someone says, give me maybe 1 million, 10 millions, so I will stop this act, right? But in greenmail, companies pay to the acquiring company to stop it. Like maybe like we can say the victim paying the offender to stop that offense. And The next defense is white knight. In this case, the target company finds a more friendly third-party company or buyer to step in and block the hostile bid. So it means that if the A company wants to acquire the company B, and B company does not approve of it, so B company brings the company C, and the C company is like battling with the A company to take over, to buy the company B. So this is a case of a white knight. The next one is the repurchasing stocks. But this is simple, right? The target company buys its own shares to regain control and reduce the acquirer's influence. And the last one is the golden parachute. And this defense offers generous exit packages to executives if the takeover succeeds, and making the deal more expensive and less appealing. So if the company A gets a hold of the company B, then the B's management executives will get like maybe in $1 billion of the remuneration, or so the company. So this deal would be very expensive for the acquirer. So all of these defenses don't guarantee the success, but they give companies tools to protect themselves and negotiate from a stronger position. And they delay time, also make opportunities for like legal battles. So using these defense tactics doesn't mean the hostile takeover will be stopped, but it gives the opportunity to target company to make to protect themselves or get more favorable deals. There's also a defense that I want to share, and it's called the crown jewel. Crown jewel means that the target company sells its the most valuable asset. So if the company A wanted the company B for its the technology, and the B company sells its technology, then it makes B company less attractive, right? So this takeover could be stopped. So this technique is called crown jewel. And let's move on. The example of a hostile takeover is Elon Musk's acquisition of Twitter in 2022. Elon Musk made a $44 billion offer to buy Twitter, but the Twitter board resisted and adopted a poison pill defense to block him. Poison pill was like this poison pill defense allowed shareholders to buy discounted shares if any investor exceeded 15% of the ownership. Means if the Elon Musk got a hold of the 15% of shares of the Twitter, then the other shareholders of the Twitter could buy shares in discounted price. So this acquiring would be hard for Elon Musk, right? Despite this, and Elon Musk persisted, and after a legal battle, he completed its acquisition in October 2022. And then Twitter was taken private and rebranded as X Corp. And after the acquisition, Elon Musk introduced sweeping changes in the Twitter, from mass layoffs to new policies, and it showed that how hostile takeovers can reshape not just the ownership, but the very identity of a company. So Twitter became X Corp after the acquisition, and the policy, the brand itself changed a lot. So this would be a case study on hostile takeover. Now let's move on to an equally important part of the M&A process, the role of investment bankers. This whole process of mergers and acquisitions and even the hostile takeovers include investment bankers. These professionals are the behind-the-scenes strategists who make these deals happen. And from identifying potential partners to defending against hostile takeovers, and their expertise shapes the success or failure of mergers and acquisitions. So their role is very important. So let's break down their key responsibilities. I have listed these 5. So first one is investment bankers help in arranging mergers, and meaning they identify potential buyers and sellers and structure deals that align with strategic goals of the companies. Then the second one is advising on defensive tactics in case of a hostile takeover. If a company is facing a hostile takeover, investment bankers may recommend strategies like poison pills or finding a white knight to protect the firm. So the before discussed defensive tactics are suggested by the investment bankers and used in hostile takeovers. The next important role is valuing companies. Of course, these M&A deals involve large sums of money, so establishing a fair and right value is very important. So this is done by the investment bankers. Their next role is financing mergers, like securing funds, securing capital through traditional loans or bonds to finance the acquisitions and mergers. And their next role could be seen in arbitrage operations. It means that investment bankers buying shares of a target company when the deal is announced. When the deal is announced, the shares are often sold below the offer price. So investment bankers buy these shares in below price, and then after the deal is made true, they sell it at a higher price. Because if the deal is successful, the price of the companies often increase. So investment bankers make profits of these arbitrage operations. And these are the most important roles of investment bankers. And to summarize, we can say that investment bankers are the architects, defenders, and financial engineers behind successful mergers and acquisition deals. Any questions? No, if you have questions, please write in the chat or open your microphone and speak. And so let's move on. As we said before, the business valuation is very critical step in these M&A deals. Before any deal is made, companies need to determine a fair bid price, fair and true bid price. And this means understanding not just the standalone value of the target firm, but also the synergies it could bring after the merger. So when valuing a firm, we consider the past operations, the present operations, and also most importantly, the future. Because after the mergers or acquisitions, the companies will have the above discussed synergies, right? So this should be also accounted in the calculation. And there are two main methods used to evaluate a business. The first one is the discounted cash flow method. This approach forecasts incremental cash flows and discounts them at the cost of equity, considering post-merger operations and synergies. So, if we have time at the end of the session, we will discuss this DCF method more in detail with examples. And the second one is market multiple analysis, and this is an approach that applies market-determined multiples to financial metrics like net income or EBITDA of comparable companies. So between these two, discounted cash flow method is often used. So we will look at this later. Now, let's look at the other side of corporate restructuring, and the other side is divestitures. Before we discussed of the mergers and acquisitions, like combining, right? But this is a divestiture, and this is like a disposal or disposal of a component or business unit of a company. So this is often used when companies want to separate their services, products, or their the values of businesses do not match within the company. So the management makes decisions to divestiture. And this divestiture can occur in four main types. The first one is a sell-off, and it's a direct sale of a subsidiary. So maybe taking the example of the Facebook and Instagram. Facebook bought the Instagram, right? And they are now like one company, under one company. But if the Facebooks and Instagrams like goals, cultures would not match, then Facebook could sell the Instagram in maybe 20 or 30 years, right? And this would be a sell-off. Another one is a spin-off. This is a little bit different because it creates a new independent company from a part of the parent company. The classic example of this spin-off would be eBay spinning off PayPal. And PayPal was the subsidiary of eBay. but it spun off the PayPal, and they became two different companies. And eBay is specializing in e-commerce, and PayPal in this payment, right? So their services separated and grew separately and became more big companies. Then the next one is a split up. In the split up, parent company is dissolves into two or more new entities. So it's the exact opposite of the merger. There was a one company, it no longer exists, but becomes two or more different companies, new companies. And the last one type of the divestiture is equity carve-out. It involves selling shares of a subsidiary through an IPO and forming a new publicly listed firm. So in the spin-off and equity carve-out both create new companies, right? Besides the parent company. But in the equity carve-out, the funds to maintain the new company is financed through the initial public offering. And while the spin-off, the parent company finances this whole process. So these are the four types of divestitures, and it can be used as a strategic tool to sharpen a company's focus and unlock hidden values within the company. Do you have questions?
Hello, everyone. Any question so far? There's around 138 students here in the room. Hello. Hello, everyone. Any question regarding our topic today, merger and acquisition?
Okay, then I will ask the questions. Please open your microphones or write in the chat.
We've got a question on the chat room.
Okay, let me see.
Yeah. On the chat, what are the most common reasons a company undertakes divestiture? Is it always due to poor business in performance, or are there other strategic reasons? Oh, we got another question. Yeah, two
Perlu
questions.
kami ingatkan,
Okay. What are the most common reasons of a company undertaking a divestiture? Is it always due to poor business performance, or are there other strategic reasons, such as focusing on the core business? Well, yes, the focus on the core business is maybe the most important reason, because having to pay attention to this business, to another, and to take account everything, the it could be a lot to take in for some companies, so they use this divestiture tools. But also it could be because of the poor performance of one department or one business. And also it could involve the reasons of debt reduction or the raising capitals.
All right. The question is, yeah, Aziza, yeah, that's your question. Does he answer your question, Aziza? Hello, Aziza, are you there?
Mm.
Yeah, I think I'm just asking the student who just confirming to the student who is asking the question whether it has answered the question or not. Oh yeah, we've got another question as well here. Undral, yeah, there's another question from Ita Febrianti.
Okay.
Yeah.
An equity carve-out takes the subsidiary public while control is still made by the parent company. How must the corporate governance mechanism be modified to prevent agency problems between the minority shareholders in the subsidiary and the interest of the parent company, which remains the majority shareholders? Okay. Mm, maybe the agency problems can be addressed by the independent boards, meaning that the subsidiary having independent directors who are not affiliated with the parent company to protect the minority shareholders' interests, or or also have oh, I forgot the word. Maybe having a policies that that safeguards the minority shareholders' rights, like maybe their voting right.
Yeah. All right. I think we've got more question coming. Yeah. There remains two questions on the chat room. I don't know why everyone is asking the question in the chat room instead of simply asking a question directly. I don't know. Yeah, we've got another question on the Zoom chat, Ondra.
Okay.
Yeah, yeah. Yeah, we got two more questions.
When a company undergoes a split up, do the resulting companies have to operate in the same line of business as the original company if they are allowed to operate in different industries? And wouldn't it make it similar to a spin-off? The companies can operate in different lines of businesses because when they were the combined companies, they could have the different operations, right? Like the shoe manufacturer and clothes manufacturer, and the clothes manufacturer could be the parent company, and it sells the shoe manufacturing part. Then it would be like the different industries, right? And sell-off and spin-off is different because in case of a sell-off, subsidiary is sold to another company. So subsidiary stays as a subsidiary. And in case of a spin-off, the subsidiary becomes new independent company. Right? And next question is,
Yeah, this question is a bit long.
let me see.
Yeah. Imagine a company that focuses on environmental technology and owns a subsidiary developing an AI-based water filtration system. The product actually has strong future potential, but the subsidiary has not made any profit because its costs are very high. At the same time, the parent company is facing pressure from investors to boost short-term earnings. And the government is asking the company to shift more attention to national green energy projects. If you were in the company's position, which type of divestiture would you consider the most reasonable choice? Sell off, spin off, split up, or equity carve out? And why would that choice help the company balance its need for immediate funding with its long-term innovation goals and its competitive position in the market? It's yeah. The question is quite long. Novia. Okay, I think
Okay. So maybe if I was in the company's position, I would recommend maybe equity carve out because environment the is the question say that it has a strong future potential, right? So
yes, yeah, yeah.
this could mean that the many investors, shareholders would be interested in that company. So we can uh, get financing from the public and the investiture that subsidiary developing an AI-based water filtration system. And this company would operate on the funds from the public, but in the long term, it will give the benefits, the profits. So the equity carve out, I think. And maybe another choice could be the sell off to another entity, which has a much bigger funds or resources to own that subsidiary, which has um, a high cost. Maybe can.
Yeah.
Oh, okay. Yes.
Yeah.
That would be it.
Yeah, yeah, yeah. I think I guess probably this is quite common, I guess. Especially for startup companies. Normally when they start business in the beginning, they might not be profitable for a number of years, but then technology companies normally they have strong future potential, but yeah, in the beginning they require a huge amount of investment. Yeah, I think I would say I agree with you on Ral. That would be carve out perhaps. I would agree with that as the most possible option, I guess. Okay, any more question, guys? I can see that there's so many students in the room chat, but I don't know why no one is simply asking a question directly. I mean, basically, instead of asking question on Zoom, perhaps if you ask a question directly, you have more opportunity to, elaborate on what you're trying to say. Um,
Okay,
Yeah.
let's move on to my question and answers. But
All right.
my
Okay.
questions are very simple. So maybe like everyone could write the answer in the chat so we can like see who is right and wrong. And these are the questions, very simple and just to uh, clarify our the knowledge from this session. So the first one is, what's the ultimate goal of mergers and acquisitions? So students, you can write in the chat or speak up. There are no answers.
Yeah. Hello, everyone. Hello. Undral is asking a question, and um, please kindly type your answer on the Zoom chat, or you can simply answer it directly. You can simply raise your hand if you want to answer the question directly, or perhaps you can type on the Zoom chat. I'm not sure what happened. Normally, these students are quite active, but I'm not sure why they're not responding yet.
Okay.
Um, Hello, everyone.
Okay, then let me answer the first question and move on to the next one. Is much, much simpler. The ultimate goal of mergers and acquisitions is the maximization of shareholder value. Like generally, every operation, every thing that the company does is in the goal of the shareholders' value maximization, right? So this was the question answer for the question one. Then next one. What type of merger happens when two competitors in the same industry combine? What type of a merger? Like one word. Please write it in the chat box, please.
Yeah, we've got a response but I think this is for the first question.
Mhm.
Oh yeah, we've got the response for the second question as well.
Okay,
Yeah.
one student answers. Any more students?
Yeah, please everyone, you can type your question on the Zoom chat.
There are like 100 of you, so you can like be 10 students maybe can answer, right? It's like a very simple question. So yes, that's a horizontal merger. And this is when the two competitors, meaning that the same industry, same line of business companies merge. So this is a horizontal. Okay, thank you. Next question is, in an acquisition, what does the acquiring company usually purchase to gain control? Oh, yes, that's right. The common shares. The acquiring company buying the target company through acquiring its common shares or its most valuable assets. Okay, next question. What does 2 plus 2 equals 5 represent in M&A? What does this equation represent? Oh, yes, that's right. The synergy concept, right? Synergy is combined company is worth more than the sums of its parts or the separate companies. So, synergy. Next question, question number 5. What is one common challenge in mergers and acquisitions integration? Oh, yes, that's we've discussed about the challenges, so you can write one from them. Yes, the cultural integration and cultural clashes are one of the challenges. Yes, there would be the conflict of interest, and there would be like overvaluation risks, regulatory risks, right? So we've discussed it. So move on to the 6th question. What risks occurs when companies pay too much for a target? Oh, this is easy, right? Yes, the answer is overvaluation. Okay, next question. What is a hostile takeover? Any answers, please? So the hostile takeover is when target company is against the deal to be acquired and it implements. Oh, yes, that's right. When the acquiring company attempts to gain control over the target company without approval, and the target company utilizes the defensive tactics, right? So the next question, thank you. Name one role of investment bankers in mergers and acquisitions deal. We've discussed about 5 roles, right? So maybe one role that you can remember. Okay, thank you for the answers. Yes, advising on evaluation, right? Arranging mergers by identifying potential buyers and sellers, and this is also right. And also, um, um, we talked about like advising on defenses, making, doing arbitrage operations, right? So the next question is, which valuation method forecasts future cash flows and discounts them to present value? We've discussed about 2 valuation methods. And this one is the most often used one. Which one is it? That's right. It's a DCF or discounted cash flow method. Next question is, what's a divestiture? Okay, the divestiture is a disposal of a part or all of the business unit. And answers are coming right now. Yes, everything is right. Yes, decision to sell, remove, or separate business unit or asset. Okay, yes, it's right. So the last question, what type of divestiture creates a new independent company? Yes, that's right, spin-off, but also it could be carve-out, right? So this concludes all the questions. And thank you for those who participated and sent the answers. And now we have like 15 minutes. So let's discuss the DCF method in more detail. And let me skip this part. So the business valuation is very critical in M&A deals. And we say that we use two methods, but the discounted cash flow approach is the most common and often used. So it involves determining the present value of the future cash flows of the company to be valued. So the value of the company is the present value of expected future free cash flows generated by it, and it discounted at the required rate of return. So it means we calculate the free cash flows after the merge or after the acquisition, and we discount these cash flows to present value, and the sum of the present values would be the value of the company. So with the calculation steps in more and more details follows like this. So free cash flow is a cash flow before interest, but after taxes and after capital expenditures. So if we have earnings before interest and taxes, we should multiply it by 1 minus tax rate, and then minus capital expenditures, and change in non-cash working capital should be adjusted. Then we would have a free cash flow. Then after that, we should and determine our required rate of return. And this can be calculated by using the capital asset pricing model. And also free cash flow is split in two stages. First is like the maybe up to 10 years, 1 to 10 years cash flow would be often it would be getting higher because the company operation after the merger would often grow, right? So this growth is this growth would be seen in these numbers. And after the maybe that 10 years or 5 years, the operation would become more stable and the growth would be minimal. So after that, so that part after the stabilization becomes the second part of our calculation. So we have the first part of the calculation where our cash flow is growing, and the second one is more stabilized one. So we should account for these two stages. And then we calculate the present value. And if there's a more risky operation, more risky service or product, we should use more higher discount rate. So this calculation would be can be seen more accurately on this example, I think. So we have a assimilated stores company, and which is considering acquiring a takeover target. So takeover target has been growing rapidly, and its growth is expected to continue for the next 5 years. So this is our stage one, right? Part one. And after that, its growth is expected to slow down to a more stable long-term rate, beginning with year 6. And takeover target has the following estimated incremental future earnings and investments in $1 million and for the next 5 years. And there's a table, right? And this projection below assumes a 17% growth rate per year and free cash flows for years 1 through 5. So we have this information on takeover target company. And it's expected that free cash flow will grow by 10.5% each year, beginning with year 6. And cost of equity capital is 15%. So what's the value of this takeover target company? So to calculate this, the value of the business, we need free cash flow, right? And free cash flow is calculated by adjusting our after-tax earnings, EBIT multiplied by 1 minus tax rate, and then subtracting the investments, right? So all this information is given to us, so we can use these numbers, 5.4, 6.3, and etc. So we have our free cash flow. Then the next step is to calculate the present value. So we said that the company would grow exponentially in the first 5 years, and then from year 6, it would stabilize, right? So first of all, we calculate the present value of these 5 years. We have free cash flow of each year, and we discount it by the equity rate, right? It was given here. Equity capital cost us 15%. So we discount it by 15%. So for the first year, we divide it by 1.15. And then it's in square and etc., right? So we discount each year and then sum it. So it becomes $24.27 million. And this is the present value of first 5 years. Next one, we determine the value of the year 6 and later on. So to do that, we are maybe. So company has now 0, 1, 2, 3, 4, and 5, right? So after the 6th year, the growth is stabilizing. So we don't have the free cash flow for every year. So we bring all these years' earnings back to the year 5 and using the Gordon growth model. So what we year 5's cash flow was 10.1. So we are using the growth rate 10.5. We find it $11.16 million is the projected value for free cash flows in the next years. So all these years would be 11.16. Okay, so we next week. Next we calculate the value of all these years, right? All these years after year 6 to combined would be $248 million, and we discount it to year 0 by using 15% of the discount rate. So the value would be for this 5 years $24.27 million, and after the year 5, the value of the company would be $123 million. So summing up these two values, we are coming up with the total value of the takeover company, which is $147.57 million. And also in the cases of the acquiring companies, target companies do not always have only just assets or the equity, right? They have also debt liabilities. So in these deals, the acquiring company gets that the liabilities are becoming the responsibility of the acquiring company. So if this deal is to be done, the acquiring company, in case of our example, the assimilated company, should minus the liabilities from the value that we calculated. So if the accumulated liability is $20 million, we should subtract it from our value of 47 millions and buy this company on $127 million. So the valuation is done like this using the discounted cash flow method. So any questions?
Everyone, any question? Any question regarding the one of the method used in valuing the merger and acquisition, which is discounted cash flow? Any question that perhaps you want to know more in detail? Um, Not sure. There is no question in the Zoom chat as well. Okay. Hello, everyone. Any question? No question? Yeah, I think Unral, yeah, 1 minute. We have 1 minute to go. I think perhaps any advice do you think you can give to the students who, normally financial management is, I would say, is one of the among modules quite difficult for a student in accounting. Perhaps any advice that you can give to them regarding how to, mastering this course, or any tip perhaps you can give. I mean, you can suggest to student how they can learn this model in an effective way.
First of all, maybe uh, we
I mean,
should
perhaps based on the experience of your student in Mandakh.
understand why we are taking this course, why this course is important. So if we have our goals and like mm, if students know what for they are studying,
Uh,
it becomes more like interesting or easier, I think. And also, nowadays we have many YouTube videos and many other platforms where we can learn. So if you have not understood the uh, topic in class, so you can go online and study more by just yourself. Also, we have like the AI's ChatGPT, so we can, if you have a will, then there is many ways to learn nowadays in this digital technology.
okay.
So,
Yeah.
what is to determine the goal, the purpose of this lesson, and
Mm.
why it's important for you, then everything will be big easy.
All right. It's been yeah, 10:31. So thank you so much, Andral, for sharing your knowledge with us. And yeah, I guess merger and acquisition is one of the important topic among the financial management topics. So again, thank you very much for, I mean, also giving the advice to our students. Um, and I remind for all of the students, please don't forget to fill the attendance list, because it's going to be part of your assessment in the module. And don't forget to submit your summary regarding the our lecture this morning. So finally, we're coming to the end of the session. So once again, Onral, thank you so much. We'll be in touch with you, of course. I think yeah, I mean, especially, my one of our colleague, yeah, Alvin, yeah, Dr. Alvin. I think has be yeah, she has a close connection with he in Mandak. So again, thank you so much. Yeah.
Thank you.
Thank you so much, everyone. Very good morning and have a wonderful day ahead.
Thank you, sir. Thank you, Professor.
Thank you. I hope this session gave
Uh,
you a little bit knowledge.
have you ever been in Indonesia, Onral? No, oh, not yet. Okay, all right. Yeah, hopefully, I mean, someday, I can come to visit us here.
Okay, I will.
And to be honest, I have been in Mongolia as well.
You should come.
Mm. All right. Yeah, I think everyone has left the Zoom meeting. Yeah, I think that's all. Thank you so much. I'll be leaving the Zoom meeting now. Yeah. Bye bye. Thank you. See you next time.
Thank you.